All right, so this morning, 15 minutes to the opening bell right now. We don't have a lot moving. This has been the longest stretch for me of no trade days that I've ever had. I have never had this many no trade days all, this close together. But I also, maybe haven't had the level of discipline that I have right now. Right now, I'm much more content to sit on the sidelines and wait for something that really looks good, than just keep reducing my quality standard and take kind of like mediocre trades. Because I've at this point in my career, and it's taken a long time to get here, but I'm sort of just like realizing that if I keep trading low quality setups, I am just going to dig myself a hole and then look back and be like, why was I trading those low quality setups in a market that didn't have a lot of momentum? In a hot market, I'll trade a low quality setup or a B or C quality setup, and it can work in a hot market. But if you do that in a cold market, that's when you start to dig yourself that hole and you're like, wow, why was I trading so aggressively during a bad market? And I've seen a number of traders talk about trading really aggressively on First Republic, taking big losses. I'm not saying that this didn't present some opportunities, but you guys knew, when I was talking about Silicon Valley Bank, I said my bias on this, my gut tells me I should leave it alone. And that was absolutely the right move. It halted not 5 minutes after I said that. I said the risk on Silicon Valley Bank is it gets halted. And, there's upside potential. I'm not going to deny that. But there's also a lot of downside risk, and I can't take the trade. It halts 5 minutes later, and it's now at 40 cents a share. So, I absolutely had the right instinct there. And that's called educated intuition. It's my gut. And my gut knows on those types of stocks, the risk is way too high relative to the reward. Now, something like FRC, just, as a brief tangent, the longer it holds up here, at 14.15, it's a bear flag right now, but the longer it holds up and doesn't fail, the more we might start to think about a possible curl back to the upside. What if maybe some big investors come out? I don't know, probably not a Warren Buffett, but maybe some big investors come out and they say, you know what, I'm going to put some money on FRC. I think it's going to go. These are they're not inside. It's not insider trading, but these are institutional traders who, they have the inside scoop. Let's be real. They're more connected than any of us could ever be. So, they believe, and, maybe they've got good reason to believe it, that FRC is not going to go out of business. And they say, I'm going to buy up, $50 million. Someone else says, I'm going to buy up $500 million. And all of a sudden you see this wave of traders, investors come back in. And then that's when you'll see, those are the whales. And then that's when you'll see the little fish like us just kind of chasing in their wake to try to capture a little sliver of that opportunity back up. That could happen. So there could be some potential there. But also, what we've learned with FDIC and the federal government right now is that the depositors will get bailed out, but not the investors. What's the price of Silicon Valley Bank right now? 40 cents. So investors lost everything, but the depositors were made whole. So I guess it's at $1, but in any case, it doesn't really matter. The fact is, it's basically worthless. It's on the OTC market right now, and investors lost pretty much everything. So it should make an investor cautious to trade FRC or invest in it. But I've seen so many people trying to day trade it every single day because it goes from 14 to 15 or 13 to 14 because it does move. To me, it's playing with fire because you could have a repeat of what happened on Silicon Valley Bank. And I certainly hope that doesn't happen, but it could happen. So, so the long and the short of it is that I do well when we have volatility, but when we have, so like, let's say last year, for instance. So last year we had, and I'll make my camera a little bigger so you can see me better. So last year we had oil, right? So we had this huge surge in the price of oil, and we saw incredible momentum. We were in a bear market, but we saw momentum on all of these small energy stocks, small cap energy stocks that went up like crazy. So if we look at our chart, what were some of them from last year? You guys call them out and I'll pull them up. We had INDO last year. This one was crazy. I mean, this stock, last year, this was in 2022, it goes from $4 a share to like $100. Look at that. That's some momentum. You had IMPP, you had HUSA. These were all energy stocks. They all made huge moves. So what we had, MXC Mexico. So we had this sector that was really strong, and that brought a lot of sympathy and momentum on small cap stocks. And then during the summer last year, still in a bear market, we had all these Chinese IPOs that were going crazy. We had HUDI. I think that this was one of them. We had HKD. I mean, it was insane. The average Chinese IPO was going up like 2,500%. So that was, even though we were in a bear market, we had these little pockets of opportunity where we had sectors that were going like straight up. So what's different right now? Well, right now we just had a sector that went like straight down, regional banking. And we had the bailout, or whatever you want to call it, the collapse of Silicon Valley Bank. We have Western Alliance, we have First Republic, we have a number of other banks, PACW stock, that are all down a lot. So what's the opportunity there? Well, there clearly was some opportunity to the short side, although anecdotally I'd seen some short sellers who were shorting these who still managed to lose money, which is epically frustrating. Because we also saw on FRC and some of the others some kind of crazy pops, especially at the beginning here. This was a pop, on this day here, there was a low and high like $45 and $95 a share. So like you could lose money short on it as well. But here's the thing. For me, I'm trading in a retirement account. So that does leave me in a bear market with a little bit, I don't have as many tools as maybe I'd like to have to work with. I could trade to the short side in my traditional account, but naturally I would pay income tax on those gains. And I'm a high income producer, so my income rate is top bracket in both state and federal. So that means ultimately I'm going to pay like over 40% of tax on any profit I make to the short side, which creates an interesting risk to reward ratio when you're in the top income bracket, because if you lose money, you've obviously got these losses. And if you make money, you only get to keep roughly half of what you make. And that's not to mention the borrowing fees and everything else. And it's also not to mention the fact that to really be a probably professional short seller, you need to have accounts with some of these boutique brokers that have higher minimums. And in any case, it's a more advanced strategy. I wouldn't say it's a beginner strategy. And I think I've been proud of the fact that for a long time I've focused on what I think is a fairly simple strategy that is a good strategy for beginners to learn. And that's not short selling. I think short selling does carry more risk. It's quite risky for beginners. Not that it can't work, it can. But in any case, so I didn't trade the bank stocks to the short side. There was some opportunity there and I missed it. It is what it is. But what the bank stocks created was some panic in the market and some fear. And trading in a market where there's a lot of fear, there's a lot of panic, creates a lot of hesitation. When there's a lot of hesitation, you end up having a lot of traders who are sitting on the sidelines. I'm included. I'm sitting on the sidelines. What we're seeing are stocks that start to pop up, but big money is not moving into these stocks. So we're almost seeing little fish biting on stocks that are starting to move, but the whales aren't coming in. So, little fish like us, we feed off of what the whales are doing in a lot of ways, but we're not seeing the whales, so to speak, doing a whole lot. So the result is that we're seeing very small moves. You might see a stock that pops up on like 50,000 shares of volume, and maybe it pops up, 50 cents, and then it kind of comes right back down. And I have seen some of you guys who have been trading, those pops, shorting as something goes up and then covering as it comes back down. But I also caution that strategy because shorting anything that pops, while it can work in a bear market, in a bullish market, that can be a very risky strategy, as you have things like INDO, which right now we couldn't even possibly imagine. But you have these stocks that, they pop, and then next thing you know, they're up $10 a share, $20 a share. And this is where you end up seeing the sort of typical P&L of a lot of short sellers. And it's just what I've seen, which is these nice steady gains, steady gains, steady gains, and then this one loss. And that sucks. And listen, I have been there myself. Having steady gains, steady gains, steady gains takes, weeks, months to get back, and then it's like this. And so that's one P&L. And this is just sort of the risk of the averaging position. And you could have this if your strategy was long and you were buying dips, because in this market, dips don't seem to get bought up. And let's look at EBS from yesterday. EBS was a stock yesterday that squeezed up, and if you were a trader who was buying dips, well, it just kept going lower. I mean, it finally bounced a little bit, but you just would have to keep averaging. And then if all of a sudden it just drops even lower, you're blowing out with a huge loss. So my equity curve right now looks a little different. It was kind of like this, and now it's kind of softened. And I've dropped down about maybe $5,000 or $10,000 off the top, and now I'm kind of going like this. All right, so this isn't, I'm saying it's not, I'm being fully transparent. It's not a lot of fun to go sideways. And this is really just over like the last 3 weeks. This isn't a big period of time, but I've never had this many no trade days in a row. I've only taken one trade this whole week. That is unusual for me. And last week I only took 3 trades. I took 3 trades last week. This is, you go back a year to last March, and I was taking 20, look at the number of trades I was taking. Not to say I wasn't having red days. Of course, red days happen, but the frequency of trading was so much higher a year ago. But yes, cash is a position, and right now I'm in the mindset of preserving capital. So one of the things that I have sort of the benefit of right now, and we've got about a minute to the bell, but I don't have anything I'm watching. The gap scanner right now, nothing on the gap scanner looks good. SCYX, it's up 72%, but it's kind of just going sideways, and now it's selling off. So this actually would have been an okay short on the break of VWAP right down there. That's a setup I can get my head around a little bit better. But anyway, so that's that. VHC floats higher at 63 million. SGBX is $1. SHFS is also 58 cents, too cheap. So leading gappers are not interesting right now. So we'll see what it looks like as we get closer, as we get through the opening range. There have been more opportunities a little bit later in the day. That's when I got my BMEA trade the other day. S&P is back above 400. And this is something that's also interesting, is that the market is holding it together right now relatively well, considering the banking crisis among regional banks. But we're also in a period in the market where, more or less in the last 2 months, the price of the S&P is unchanged. You go back to December, 3 months ago, 4 months ago, we're kind of at the same spot. So we're definitely range bound. We're range bound, and it doesn't feel like the sentiment right now is particularly strong. There's a lot of traders who are just sitting on the sidelines. They're like, I don't know, I'm not feeling it. Small traders have probably gotten chopped up. Maybe some of them have even blown up accounts. Big money traders, maybe I'm not even a big money trader, but bigger traders like myself perhaps are just like, well, there's not a lot of opportunity, so just sitting on the sidelines with our capital. And all of that culminates with less volume, less liquidity, and in a way it becomes a self-fulfilling prophecy where it creates less volatility. So this is sort of an interesting thing when the market stalls out like this. How does it kind of like reignite? What needs to happen for things to like, kind of get the wind back at our sails a little bit here? So I would say that what we really need is we need a stock ultimately that does go really crazy and it catches people off guard. And we might not know ever why that stock made that move. It could be that some big investor out there decided they wanted to accumulate a big position. They just created a tremendous amount of buying strength and pressure, and it overwhelmed short sellers, and they got squeezed out, and then longs start to come in a little bit. So all of that could create a big move, and then that would would kind of get some traders back off the sidelines, seeing, okay, we've got some action. It's time to step up. Obviously, the Federal Reserve pausing the increase in interest rates and eventually bringing the rates back down will have a big effect on the larger market. And I don't know to what extent, high frequency trading algorithms and things like that have been tuned differently to a bear market than they were in a bull market when we were seeing stocks going crazy like every day. So we may have some sort of institutionalized headwind that's holding things back a bit. So, all of that is to say that I think the best way to get through these periods is through discipline and patience. I have been through these cycles before, and that's what I look at them as cycles. The market is very cyclical. We have hot cycles and we have cold cycles, and we are on a cold cycle. And this is one of the longest, well, it's not the longest one, but it's one of the, it's the coldest cycle in the sense that I've been willing to just sit on the sidelines and not trade. And I haven't had this many no trade days probably ever. But that also is because I'm more disciplined than I might have been, a couple years ago. So, a couple years ago, I would have kept trading, dug myself into the hole and gotten frustrated. And so right now I'm just kind of, I'm on the sidelines and I'm not willing to participate and trade too much in a market that's not really providing a lot of opportunity for the strategy that I trade. And I've been trading for a long time, long enough to know that these cycles come and go, and that when it's hot, that's the time for me to push hard and to step up to the plate. And when it's cold, the best thing is for me to be patient. Now, obviously, the more strategies you have in your tool belt, the better equipped you are to sort of weather through the storm. And there's nothing wrong with looking at trading to the short side or being willing to explore different strategies, but you want to be careful that you're doing it from a place of genuine curiosity and not desperation. When you start getting desperate, you're like, I'm not making any money, I need to be making money. Then you can start putting too much money on the line in an unproven strategy. You find yourself with losses, you get even more frustrated, and that really makes the situation worse. So this could be an okay time to be practicing in a simulator and just, testing out trading the short side or testing out mid caps or large caps or whatever you want in a simulator in a safe environment. And for other traders, like myself, who have done quite well and have a real substantial track record, it's also okay to say, you know what, this is a time where I'm gonna, take a vacation, take a week off, and come back when things pick back up a little bit. Now, I'm not doing that exactly. I mean, I am still here. I've logged in every day, even though I was traveling last week. But I'm really not willing and interested in putting myself in a position of taking unnecessary losses. So right now, so far, it's a no trade day. I'm totally okay with that, and that for me is sort of a big development. But I think it's important that I'm not a gambler. I'm not here just to press the buttons and get the thrill of either having a big win or a big loss. I am trading a strategy. It's a proven strategy. I've traded for a really long time. I've traded it through ups and downs in the market, through hot and cold cycles. We've had periods that have been extended periods of very slow trading, and I've gotten through it in different ways, sometimes just by trading, 1 or 2 trades a day for, a few weeks, a few months, whatever it is. And then on the other side of it, in the next hot cycle, it's like, wow, night and day. It's crazy how much different the market feels, between these hot and cold cycles. And when it's cold, it sometimes feels like it's never going to get hot again. And when it's hot, you think it's never going to get cold. It's just it's a mental trap in the way many of us think about trading. So my opinion right now is just to, put in the time, sit in the chair, look at the market, watch, see what we get for opportunities. If we, I'm happy to sit down, at my regular time, and I'm happy to sit here a little bit later in the morning and see if we do get some, 9:30 to 10:30 momentum. But if we don't, I'm not going to sit here till 4 o'clock. Some people will, and you may find some sporadic opportunities at different times of the day. But doesn't it seem to make more sense to put in the extra time when the market's hot? Isn't that when you're going to get the most return for your money? And when it's cold, wouldn't it make sense that this would be the time that you focus on some other endeavors that you have, whether it's other strategies in trading or it's side hustles that you have that could be income producing? Because one of the things that we know is that the traders who tend to make the most are the ones who need it the least from trading. In other words, they have several sources of income. They're very financially comfortable, and they don't feel the insecurity, the desperation, or the pressure that can lead a lot of beginner traders to become impulsive and irrational in the way they trade. So I'm grateful to be green on the year. I'm very happy for that. A stock like FRC or Silicon Valley Bank, if I trade it the wrong way and God forbid was in a halt, that could change the way my year looks substantially. 5,000 shares at $40 a share, that could be a 6-figure loss. I certainly could do without that. So I'm being a bit more cautious. I'm exercising some restraint, and I think that is the right move for right now. I am being a little bit stubborn by not trading much of anything to the short side, but like I said, with taxes and sort of the risk reward ratio on it, and the fact that I don't really think it's a suitable beginner strategy, I'm comfortable with my position on that for right now. So always subject to change, but for what it's worth, I mean, a few years ago when everyone's talking about crypto, oh, the market's slow, why don't you trade crypto? Why don't you trade crypto? People tend to flock to different things that are of interest, and I never got into that. And while maybe I left some money on the table, there was some opportunity there. At the end of the day, I think my gut feeling on crypto was that I didn't really trust it, and I didn't feel comfortable with it. And with everything we saw with FTX, and some of these other exchanges, I think that was the ultimately, as it turned out, the right move long term. But so anyways, right now I'm just sitting tight, and we'll see whether or not anything does show up today that looks good. But like I said, I'm perfectly content to be patient. This is a great time to be studying. If you can make it in this kind of environment, and make it, generally speaking, like keep your head above water, that is going to be a really good indicator for your future ahead, for sure. I guess unless your strategy, so if you trade a very similar strategy to me and you're able to keep your head above water, that's really good. If you're trading the short side, then that's different, because that, when we go back into a bull market, you may find these stocks are just irrationally strong, and that will be a more difficult strategy during that period of time. But it really does depend. So it's a good time to be gaining experience, learning more about market sentiment, being patient, and keeping your head above water. One of the things that's true is that a lot of traders will stay out of the market completely during these times, and they're missing the opportunity to gain experience. So try to at least make the best of this opportunity and gain some experience, and I think you'll be happy as a result of that. Yeah, so I see APLM. Let's see. Yeah, so APLM. The problem is you've got 100,000 shares of volume. This is the challenge with these. It's just not. It's not a lot of liquidity. I wouldn't be able to get in and out with any reasonable position. So I'm just not really wanting to scrape the bottom of the barrel on that. I want to be trading things that I think big traders are going to be moving in and out of, where we'll have liquidity, where I can size up, and if I can be a sniper with a few of those trades each month, those are going to pay really well. And for what it's worth, I had a great day. What day was it? When we had OCEA, I think it was. I had an $11,000 day on OCEA. Had let's see, there was another good day in there. What was it? $18,000 day on BAER. So, I've had a couple of good days recently, and that's maybe an interesting, an interesting sort of attempt right now, or a thought of, what if I had, just, 20 days like that this year, 20, 15, $20,000 days. That could mean I have a lot of days of sitting and being patient. And then I have some days where I'm stepping up and hitting hard. And on the days where I step up and hit hard, it more than makes up for the days of, going sideways, being patient, staying at cash. Right? So, you've got 250 trading days in the year, and my good days are $10,000 and higher. 15 to 20 is a great day for me right now. So if I had, 10 $10,000 days this year, it's 100 grand. If I have 20 of them, that's 200 grand. 30 of them, 300 grand. And if I have a couple days in there that are 15 or 20, that's going to be even more. So that comes back to asking the question of, is this the market right now where I'm going to see that kind of profit? And although, maybe catching, one of these really light volume stocks with 2,000 shares for 10 points could do it. The days where I really do the best is when we have a stock that's very liquid and I can move in and out with 15, 20,000 shares and capture, 30-cent moves, like 5-6 grand, and do that 4 or 5 times in one day. Those are the days I do the best. Yeah, it's every now and then I'll buy a stock, it'll halt up, it'll open 5 points higher, and I'm up 10 grand. I'm like, whoa. But for me, that's always just been so like hit or miss, and it happens, it does happen sometimes, but I don't feel like I can count on that. I need the liquidity, I need the volume. So anyways, that's kind of that's my 2 cents on current market, state of the market, and I'm being patient right now. It's about 9:45, so we'll see if anything else starts to look good between now and maybe 10:30. All right, so just sharing that with you, and I'm gonna sit here and be patient.